Under 30 time, we're looking at Ford Motor Company. It's been just everything seemingly going wrong for these big three automakers, Ford in particular, Jenny. Stock struggling. I have to think that a lot of this has to do with just the withdrawing altogether of guidance, not providing that. Look, if you're an investor and you're seeing that, your first thought is, well, you didn't want to tell me a bad story, so you just didn't tell me a story. I'm going to assume it's a bad story.
Yeah, and I think at this point we can all connect the dots and say it is a bad story. I mean, GM, I thought was a pretty brutal move after their earnings were fine. They also withdrew their EV guidance. Ford's move just makes GM's move look like nothing. I mean, 11.5% to the downside here. Here to tell us more on what's driving some of this selling, I'd like to welcome in George Tsilis, Senior Markets Correspondent for the network. So, George, I would have said that a lot of this pessimism was priced in, but I guess not. So walk us through this report.
Well, I mean, here's just another example of how cheap stocks can get even cheaper, considering you guys are right. If you look at the price action, we're hitting around the $10 or so area, which is actually a pretty significant weekly level of support. We'll see how things go for the price. But look, look, first of all, the estimates, they were expected to come in around 45 cents. They missed that, 39 cents. Now, they did grow their earnings relative to last year, coming in at 30 cents last year for the same quarter. So there was positive there. There was positive growth in earnings there, but also sales improved considering 37.5 billion last year. They came in at 44 billion, beating the 41 billion estimates. But there are some challenges. One, you look through this report and they talked about how they took a $1.3 billion loss in their electric vehicle segment. This is supposed to be an area where they're supposed to charge high prices and, of course, increase volumes of sales. That hasn't come to fruition. I think if you look at their strategy across not just Ford, but the big three automakers have been really to focus on lower volumes and higher prices. And I think the other thing is that that business strategy has failed. Looking at the performance of the price action or performance of the stocks, because people are now, price conscious, and interest rates have really held people back from buying cars. Ideally speaking, there's a situation where I think with the UAW strikes as well, coming out and saying they're not going to provide guidance for the fiscal year. To me, that's pointing the finger. I think the company's pointing their finger at the UAW for the woes that they've been facing. But, at the end of the day, when it comes down to the pay of workers are not getting paid on a per unit basis. They're getting paid either hourly or hourly. So I think the strategy should switch. I don't really suggest anything for specific companies, but maybe they should start producing more vehicles and actually flooding the market with more supply, getting prices down to places where people can afford, or levels where people can afford. And that way they could pay their workers more money as well.
Yeah, maybe easier said than done, but I think the sentiment resonates. Question for you, though, George, and maybe I'm speaking for the next-gen investor, maybe I'm speaking for many, but I look at this and I see a stock that sort of perpetually struggles in this $10 to $15 range. It's down 11% today. Okay, Alphabet, just to throw another name out here, was down 8-9% after its earnings. But I feel like investors maybe look at a name like Alphabet and say, hey, this stock might make this back in a reasonably short amount of time if things turn around and turn to sentiment. There might be growth down the line. Like, I look at Ford and it seems like the feeling is that there's bad ahead and the stock's struggling. Like, I just don't know what gets someone to click the button for this name right now with real optimism when they can look elsewhere.
Yeah, so, I mean, just look at the 2-year trend. Ford has been drifting lower. Alphabet has been drifting higher, albeit, again, this week has been terrible for investors in that stock because of the earnings. But also, I think there's been selling in some of the mega caps to raise cash, perhaps to buy bonds. And we may end up seeing selling in the mega caps because we're near the end of a correction. I can't say if that's the case for sure, but that's what I surmise is going on. But I think for Ford, the recovery now of the stock price relative to the decline we're seeing today is going to take a lot more, because if you look at the earnings estimates for the following year or next year, they're actually lower than 23. They pulled the guidance for 23, lower estimates for next year. So that means that earnings growth is going down, and therefore the stock price should go down. That's not the case for Alphabet. So if you were to say, hey, which one would probably recover the loss first, you'd have to go with Alphabet just because of the financial profile of earnings growth improving going forward, not necessarily going down, which is the case for Ford.
Yeah, I think they're really well put, George, and I think that all things considered, this name, I mean, now that we have the strike behind us, that could perhaps be a more long-term positive, but we have to consider the impacts of this. It's not going to be something that goes away, and it's going to be something you have to pay for, frankly. But we'll leave it there. Really good breakdown on all things Ford. George Tsilis, senior markets correspondent here for the network.